Before watching this mini lesson, we recommend that students watch the video titled, "What is a Mutual Fund?" found in the Investment Fundamentals series, which we have included in your subscription. Mutual funds are a little easier to understand, so we start with them and then build on that knowledge by talking about an insurance product known as segregated funds. Now, I'm going to assume that you've watched that lesson and therefore you know a little bit about how mutual funds work. You should also be able to explain what a managed product is and know the answers to these questions. What is a management fee? What is the management expense ratio, also known as MER? What is the net asset value per unit, also known as NAVPU, etc. Let's try a little exercise. Using only 3 key words, how would you describe what a mutual fund is? You might say it's an investment. And the same can be said of a segregated fund. In fact, at SeeWhy, we often refer to segregated funds as the insurance industry's fancy version of a mutual fund because they share a lot of similarities, but they also offer some pretty cool features that mutual funds do not. In this mini lesson, we're going to touch on the following: the ownership structure of segregated funds, where the name segregated fund comes from, and 3 key features that segregated funds offer that mutual funds do not. We'll also address what's the catch when buying these funds. Now, before proceeding, I need to point out that in order to sell mutual funds, you must be mutual funds or securities licensed. Segregated funds are an insurance product, so you need to be insurance licensed to offer them to clients. When you invest in a segregated fund, you're entering into a contract with an insurance company. This is why they're also referred to as individual variable insurance contracts, or IVICs for short. Going forward, I'm primarily going to refer to them as segregated funds, or maybe even seg funds. The name segregated funds stems from the fact that the fund's assets are held in the insurer's name, but those assets are kept separate from the insurer's other assets. In other words, they're segregated. The segregated assets provide security for the fund unit holders. The contract will outline many things, such as the type of fund, the management expense ratio, disclosure of risks, commitments made by the insurer, etc. As I previously mentioned, seg funds offer 3 pretty cool features that mutual funds do not. 1. Segregated funds must offer a minimum guarantee of 75% of the investor's principal upon the annuitant's death or the contract's maturity date. Some guarantee as much as 100% of the principal. Now, no fund can guarantee more than 100%, as that would be guaranteeing positive performance, not just the principal. 2. Under certain circumstances, segregated funds are creditor-proof. In other words, if you are filing for bankruptcy, your creditors may not be able to get their hands on it. And 3, segregated funds allow the potential to avoid probate fees upon death. We'll discuss these features later on in the video series, but for now, know that depending on the investor's circumstances, these advantages can be very meaningful. You may be wondering, since segregated funds offer these really cool features that mutual funds don't, why on earth would anyone buy a mutual fund? Well, there's a catch. For example, maturity guarantees do come at a cost. All else being equal, an equity segregated fund would charge a higher management fee than an otherwise equivalent equity mutual fund. So which is best, a mutual fund or a segregated fund? The answer is it depends on the individual investor's personal situation and needs. For some investors, the features that segregated funds offer could warrant paying a higher MER. Other investors may prefer a mutual fund with a lower management expense ratio. Keep in mind that if a fund generates a 10% return prior to fees, the lower the management expense ratio, the higher the after-fee return.